Welcome back. At the end of every week, we like to take a look back at our most significant economic numbers so we can hope to get a gauge on what's happened within the economy, what the Federal Reserve is most likely to do in the next meeting, and the implications for the markets. This past week, Reuters reports U.S. wholesale inventories fell for a second straight month in November, suggesting that a slow pace of inventory accumulation could undercut economic growth in the fourth quarter. This is a pattern that we've seen throughout the week. Disappointing numbers. In particular, we can see motor vehicle parts, that was up 11%. That's good news. Machinery, that was up 15%. That's good news too. However, the apparel sector of wholesale inventories is down 23%. Wholesale inventories, when it goes down, it shows us that the businesses are bracing for a slowdown. They're not keeping as much product on the shelf. Wholesale inventories, we can see the different lines represent the different subsectors. And in particular, we take a look at motor vehicle parts. Green line, that is trending to the downside. In fact, all these lines are trending to the downside. So is machinery. Those are the two of the strongest sectors within wholesale inventories. However, apparel historically is very sensitive, and there's just less apparel, less inventories out there, indicating at least the apparel distributors and manufacturers are nervous about the foreseeable future. Farm products also quite weak as well. But notice a pattern overall. We see a steady decline to the downside. Now, also on Reuters, slightly hot December US CPI suggests the Fed won't rush to cut rates. This was on Reuters. U.S. consumer prices increased more than expected in December as rents maintain their upward trend, which could delay a much anticipated interest rate cut in March for the Federal Reserve. This is CPI over the past year or so, and we can see the latest report 3.3%. It's the highest in 3 months on a year over year basis. Now, core CPI, excluding food and fuel, that's at 3.9%. That shows us a continued slow trend to the downside. So the takeaway from this, excluding food and fuel, inflation is subsiding, but with food and fuel, it's a lot more sticky. Now, again, the relationship is actually very interesting. CPI is greater than it was last month. It went up hot. Core CPI, excluding food and energy, was below last month. So the current CPI strength is found in food and fuel. Now here we see the subsectors of the CPI number, and in particular we see core CPI is greater than CPI. We see food outside the home, meaning restaurants, up 5.2%. Electricity is up 3.3% as well. Interesting, airline fares is down 9.4%. We're getting better prices for airlines. But the big headline, the big takeaway is 6.5% on a year over year basis increase in the cost of rent. And that is really the concern, that the Federal Reserve sees a lot of inflation in rent. Now we can see here the bars represent CPI. The white line shows us the inflation target. That's where the Fed wants us to be, 2%. However, we can see the red line, that's inflation, and that's sticky. Oh, I'm sorry, that's the Fed funds futures. That's sticky. It's not going down anytime soon, at least according to what the Fed says. The Fed says we're not going to see an interest rate cut until we get down to 2% CPI. Again, right now, 3.3. And core CPI, same situation, we're at 3.9%. But that needs to be down in the 2% level to justify a Fed cut. Core CPI is still well above its 2% target. Now, on Reuters, at the end of the week, it was announced U.S. producer prices unexpectedly fell. Goods deflation seen persisting. So you're going to notice a disagreement, a divergence. We just said that consumer price index is hot, that the CPI is well above the Fed target of 2%, meaning the Fed should not be cutting rates anytime soon. Well, on Reuters, it said U.S. producer prices unexpectedly fell in December amid declining costs for goods such as diesel, fuel, and food. Well, we just said that fuel and food is rising and is very strong on the consumer price index, but it's declining on the producer price index. The producers are paying less, but they're not passing on the savings to the consumer. Now, this suggests inflation would continue to subside and allow the Federal Reserve to start cutting interest rates this year. So we have to ask ourselves a question. Is the Fed watching CPI or is the Fed watching PPI? Here we see on a month over month basis, producer price index, including food and fuel, dropped more than core PPI, meaning that PPI, including food and fuel, we still see quite a bit of inflation. Down 0.13% on the PPI, core PPI, excluding food and fuel, basically flat. Now, producer price index on a year over year basis, it rose, but it rose less than core PPI, excluding food and fuel. So we see on the producer level, the food and fuel are declining. Now, this is very interesting. The report from the Labor Department, and this is also from Reuters, also said that the prices for services were unchanged for the third straight month, and this implied a pickup in consumer prices last month was likely just a blip. Again, the hot consumer price index number that we saw earlier this week was likely a blip. Don't pay attention to that. We should pay attention to the producer price index, which is telling us a Fed cut is sooner in our future. Well, the Fed funds futures seem to agree. The red histogram bars show us a chance that the Federal Reserve in March will cut interest rates. We can see on January 10th, it was 65%. January 11th, 70%. So there is an increase in the probability of a Fed cut to the 5.25 range from the current 525, 550. And we can see just a couple days ago, there was a 33% chance the Fed would keep rates unchanged. Now that's 27. If you have not already, please join our brand new Substack newsletter. Our first article entitled The Business Cycle. We take a look at long-term business cycles and how they're determined based on the behavior of stocks, commodities, and bond yields. It's a very interesting read. It's long-form economic analysis, so we really get into the details. And you can read that anytime you wish. Just go to substack.com. It's free, no registration required, and simply enter in just the data and ensure that you enter in as well the underscores, just underscore the underscore data. And in addition, please visit our Twitter page, just the data as well. We post there interesting ideas throughout the week. We hope this has been helpful. We look forward to seeing you back soon.